Welcome to today's deep dive. When we picture artificial intelligence, we usually imagine something entirely intangible.
Oh, absolutely. We call it the cloud for a reason, right?
Right, exactly. We think of it as software or algorithms, just,
Yeah.
pure math floating in the digital ether. It feels completely weightless.
Yeah, but the reality of AI is it's actually brutally physical. I
Okay.
mean, it is heavy, it is incredibly hot, and it requires these just vast, sprawling factories.
Yeah, and the power grids, too.
Oh, totally. Power is equivalent to small cities just to exist. We've been conditioned to think of tech as something that transcends the physical world, but every single chatbot prompt is anchored to, well, silicon and steel.
And right now, that massive physical reality has a serious choke point. So today we are looking at the hidden engine of the entire AI revolution. We're talking about high bandwidth memory chips, or HBM.
Right, the stuff that actually makes the AI run.
Exactly. And to get to the bottom of this for you, we are looking at a serious stack of research. We've got an institutional KB securities report on SK Hynix, a Meritz asset report on Samsung, and a highly skeptical investment memo on Micron from a group called Ticker to Thesis.
Yeah, and we're also pulling from financial news coverage detailing a pretty wild NASDAQ debut for SK Hynix.
Yeah.
It is a fascinating cross-section of perspectives.
It really is. I mean, we have this extreme institutional bullishness colliding head-on with deep, calculated skepticism about how markets actually price innovation.
Definitely.
So our mission for you today is simple but crucial. We are going to decode whether this current multi-billion-dollar memory chip boom is a permanent structural shift in how our tech works, or, if it's a massive cyclical bubble with a hidden trapdoor waiting to spring open.
Right. And to understand the financial frenzy surrounding these companies, we first have to really grasp the physical reality of what these chips actually do.
Yeah, like why they are suddenly the most sought-after components on the planet. Okay, let's unpack this. Think of a standard computer chip as a really smart processor.
Mm.
When you get into AI, you're using specialized chips, like the famous ones made by NVIDIA. And these AI accelerators are incredibly fast. I mean, they perform millions of calculations in a fraction of a second.
But they have a fatal flaw, right?
Yeah.
They are starving for data.
Exactly. If you can't feed them information fast enough, these million-dollar server setups just sit there, they're idle, waiting for the next piece of math to do.
Yeah, and that is where high bandwidth memory comes in. Because HBM isn't just, a slightly faster version of the memory in your laptop. It's a completely different architectural beast.
So how is it different physically?
Well, to solve that data starvation problem, engineers had to get really creative with physical space. Imagine taking multiple memory chips and stacking them vertically.
Like a skyscraper.
Exactly, like a tiny skyscraper, right next to the AI processor. And to connect these stacked layers, they drill microscopic holes directly through the silicon.
Wow.
Thousands of them, actually. And they fill them with conductive material. This creates these massive parallel pathways, allowing data to just fly back and forth through the processor at speeds that were previously unimaginable.
So without this specific 3D stacked memory, the entire AI boom basically grinds to a halt.
Totally. The processors are useless without it.
It's like a high-speed rail system for data. NVIDIA is out there building these massive state-of-the-art train stations capable of handling millions of passengers.
I like that analogy, yeah.
But companies like SK Hynix and Micron are the only ones currently laying these specialized multi-lane high-speed tracks to connect them. If you don't have the tracks, the station doesn't matter.
Right. And because they're the only ones laying these tracks, the scale of this financial boom is just staggering. SK Hynix currently holds a massive 56.4% global market share in HBM.
That's huge. And the KB Securities report notes that SK Hynix's first quarter operating profit hit 37.6 trillion won. I mean, that is up 406% year over year.
Yeah, and that's just a backward-looking metric. The forward-looking demand is even more intense.
Oh, definitely.
The CEO of Micron has explicitly stated that their high-bandwidth memory is sold out through 2025 and substantially booked for 2026. Having a flagship, multi-billion-dollar industrial product completely sold out for years in advance is, well, it's a historical anomaly.
The Murray Asset Report really puts the scale of this forward demand into perspective, especially when you look at the buyers. They highlight an AI cloud provider called CoreWeave.
Oh yeah, the CoreWeave numbers are insane.
Right. CoreWeave has a $99.4 billion order backlog.
Right.
To put that in context, that backlog is equivalent to 50 times their quarterly revenue.
50 times. That is just hard to wrap your head around.
And it's not just the smaller specialized players, you know? When we look at the hyperscalers, the massive dominant cloud service providers that effectively run the internet, the numbers get even crazier.
Yeah, Google Cloud has a backlog of $468 billion. Amazon Web Services is sitting on $365 billion.
If we connect this to the bigger picture, this demand isn't just like a loose forecast or a hopeful projection on a spreadsheet.
Not at all. These hyperscalers are terrified of supply chain hiccups. If you are Google or Amazon, your entire corporate strategy for the next decade relies on building out this AI infrastructure.
Right. You cannot risk that multi-billion-dollar build-out just because you couldn't secure enough memory chips.
Exactly. So to eliminate that risk, they are signing 3 to 5 year non-cancelable long-term agreements, or LTAs, with the memory suppliers.
Meaning they can't just back out if they change their mind?
Right. These contracts essentially create a tangible, legally binding floor for memory earnings. The buyers are locking themselves in, essentially guaranteeing the revenue for SK Hynix and Micron.
And according to the KB Securities report, the nature of AI itself is changing, which is only going to make this thirst for memory worse. We are moving from generative AI, you know, like the chatbots that summarize an email for you, to what they call agentic and physical AI.
Right, and that shift is massive.
It is. This is AI that can hold the memory of past interactions, make autonomous, sequential decisions, and actually execute multi-step tasks in real time. Operating like an independent agent requires exponentially more memory to hold all that context at once.
Yeah, KB Securities and even Intel's CEO are predicting severe chip shortages lasting until 2027 or 2028, specifically because of this architectural shift.
Some estimates in our sources even say the structural shortage could stretch beyond 2030.
It really paints a picture of a permanent evolution of the technological landscape, a world where the providers of physical memory hold all the negotiating leverage, because the software companies, well, they literally cannot build their products without them.
Hold on, though. If that's the case and I'm looking at my portfolio or trying to understand the broader economy, this sounds like an absolute guaranteed win.
You would think so, right?
Yeah, I mean, the products are literally sold out. The biggest companies on earth have signed non-cancelable contracts. The margins are astronomical, and profits are up 400%. The upside here must be unlimited.
Well, this raises an important question, and it's where we really need to introduce the Ticker 2 Thesis investment memo on Micron. In the financial markets, identifying a great, highly profitable company does not automatically mean you have found a great investment.
Right, and I am looking right at this Ticker to Thesis memo, and it gives Micron a pass recommendation, even at a start price of around $419.
Which is wild when you consider the fundamentals.
Exactly. They acknowledge every single bullish data point we just talked about, the incredible 65% profit margins on HBM, the sold-out status, the technological lead, the long-term agreements.
Okay.
But their mathematically calculated fair value for the stock is only around $435. That is the negligible 3.8% return. How can the upside possibly be that low when the company is printing money with 65% margins for the next 2 years?
Because of the mechanics of the efficient market. The market is a massive information processing machine. Every single hedge fund, institutional investor, and retail trader can see those exact same backlogs.
So it's not a secret.
Not at all. They all know Micron and SK Hynix are sold out. They all know about the 65% margins. So the market has already factored that sold-out supercycle into the current stock price.
You are not discovering a secret. You're just paying a premium for a reality everyone already agrees on.
Precisely.
The Ticker Thesis memo points out that Micron's forward price-to-earnings ratio, the PE ratio, which measures how much investors are willing to pay for every dollar of expected earnings, is sitting around 9.6. Now, in almost any other industry, a forward PE under 10 means a stock is incredibly cheap, almost like a deep value play.
Yeah, but in the highly cyclical semiconductor industry, a low forward PE is often a blaring warning siren. It isn't a sign the stock is undervalued.
It's not.
No, it is the market explicitly recognizing that the company is currently at a finite peak of extraordinary profitability.
Oh, I see.
The market is collectively saying, yes, Your earnings over the next 18 to 24 months will be astronomical, but we do not believe these 65% profit margins are a permanent structural shift. They will eventually collapse back to normal levels, so we refuse to place a high multiple on today's inflated earnings.
That brings us to the core bear case, the trapdoor. Ticker to thesis calls it the air pocket risk. What if this massive multi-billion-dollar capital expenditure by Amazon, Google, and Microsoft isn't actually based on proven, scaled returns on investment?
Right, what if they aren't actually making money off AI yet, and this is just a FOMO-fueled land grab to ensure they don't get left behind?
Exactly. The fear of missing out is a powerful economic driver, but it creates incredibly fragile markets. The memo draws sharp historical parallels to the telecom fiber optic bubble in the year 2000.
Oh, that's a great comparison.
Back then, companies spent billions laying underwater fiber optic cables, assuming internet traffic was going to double every 100 days. The traffic didn't materialize fast enough, the companies couldn't monetize the infrastructure, and the whole sector collapsed.
And they point to a more recent example too, right? The crypto winter of 2022.
Oh yeah, where companies hoarded GPUs to mine digital currency, driving prices to the moon, until the math simply stopped working and demand just vanished overnight.
So investors buying into these memory companies right now are essentially being asked to pay full price for a flawless, best-case scenario to play out over the next 5 years. Meanwhile, they are underwriting a severe asymmetric risk.
The asymmetric part is the killer. You are risking a catastrophic downside for a tiny 3.8% upside. If just one major cloud provider, let's say Meta, suddenly announces, hey, we are pausing our AI spending because the revenue isn't justifying the cost, the entire demand narrative evaporates.
Yeah, ticker to thesis warns the stock wouldn't just drift down. It would gap down 30 to 40% instantly as every algorithm and hedge fund rushes for the exit at the exact same time.
You are risking 40% of your capital on the assumption that the world's biggest tech companies will continuously spend tens of billions of dollars on AI hardware without ever hitting a budget constraint.
Or demanding a return on their investment. It is a classic setup for a cyclical collapse, heavily masked by current, undeniable operational excellence.
And the risk isn't just on the demand side either. Let's assume the hyperscalers keep spending forever. There is still a massive looming risk on the supply side. We really need to talk about the elephant not in the room, Samsung.
Yes, right now SK Hynix and Micron are enjoying an incredibly lucrative duopoly in this premium high-bandwidth memory market. They are the only two invited to the feast.
But Samsung is the historical giant of the broader memory industry. They have dominated memory production for decades.
Yeah.
So why is the biggest, most resourced player sitting on the sidelines while SK Hynix and Micron eat the entire pie?
It all comes down to the brutal physics of semiconductor manufacturing. Remember those microscopically thin layers of silicon stacked like a skyscraper?
Yeah.
Samsung bet on a specific packaging technology to fuse those layers together for their latest generation of chips, a process called thermal compression bonding. And they have fundamentally struggled with the physics of it.
Struggled how exactly?
Well, applying the extreme heat and pressure required to melt the microscopic solder bumps between the layers is causing the delicate silicon wafers to warp.
Oh, wow.
The alignment gets thrown off by fractions of a millimeter, and the whole chip is ruined. According to the Meritz Asset Report, Samsung's yields on their premium HBM3E chips have been sitting below 50%.
Meaning more than half the chips they put through this incredibly expensive, time-consuming manufacturing process just end up in the scrap bin. That is brutal for unit economics.
It really is.
Here's where it gets really interesting for you listening. It's like watching a high-stakes staring contest. SK Hynix and Micron are currently locked safely inside, enjoying this luxurious all-you-can-eat buffet of 65% profit margins.
And Samsung is on the outside.
Right. The biggest, most aggressive guy in the room, Samsung, is stuck outside in the cold, furiously picking the lock to get in.
And Samsung has effectively unlimited capital, immense engineering resources, and a direct mandate from the South Korean government to win the global AI race. They will throw money and talent at this thermal compression yield issue until the physics are conquered.
They won't just give up.
No way. The ticker to thesis memo outlines a very specific kill condition for the memory bull thesis. If Samsung resolved its yield issues and gets their chips qualified by NVIDIA for mass production earlier than expected specifically, before the fourth quarter of 2026, that lucrative duopoly slams shut.
The irony here is just delicious. The customers, NVIDIA, Microsoft, Google, they're actively rooting for the current duopoly to fail.
Oh, absolutely. Hyperscalers despise lacking supplier leverage. Right now, because SK Hynix and Micron are the only reliable sources of HBM, those two companies have total pricing power. They can dictate terms.
So Microsoft and Google desperately want Samsung to solve their yield issues and flood the market with supply.
Exactly. A competent third supplier immediately breaks the duopoly, creates a vicious price war, and drives the cost of components down for the buyers.
If Samsung breaks the lock on the door, Ticker to Thesis predicts those fat 65% profit margins will rapidly compress down to a normalized 50 to 55%.
Which is still a profitable business.
It is, but it completely shatters the narrative that these memory companies have permanently evolved into high-margin software-like monopolies.
Yeah, the market equilibrium would reset almost immediately. The narrative shifts from unprecedented structural supercycle back to, well, competitive commodity hardware.
And when that narrative shifts, the stock multiples contract violently to reflect a return to a normal pricing environment, wiping out billions in shareholder value, even if the companies remain profitable.
So we've mapped out the intense fundamentals, the staggering AI demand, the incredible physics of the chips, the non-cancelable contracts.
And we've mapped out the lurking trapdoors, the air pocket of demand drying up, and the threat of a Samsung supply flood.
Right.
Now, we need to look at how all of this underlying tension actually plays out in real-time trading. Let's look at the SK Hynix NASDAQ debut in July of 2026, because it perfectly illustrates how chaotic and utterly disconnected the financial markets can be from the physical reality of the factories.
That NASDAQ debut was just historic in its scale. SK Hynix raised $26.5 billion.
Yeah.
It was the largest U.S. share sale ever executed by a foreign company.
And the demand from American institutional and retail investors outstripped the available shares by roughly 7 times.
Which is just wild.
And they are taking that massive pile of cash and using it to build actual physical infrastructure. They earmarked $3.87 billion for a massive advanced packaging plant in Indiana, which is aiming for mass production in the second half of 2028.
It brings it all back to that heavy physical reality we started with. But the trading of the stock itself after the debut was absolute madness.
Total madness.
It was a textbook example of modern market volatility. In just 4 trading sessions, the newly listed stock advanced 13%. Then a few days later, it crashed 15.4% in sold trading.
That single-day drop wiped out $100 billion in market value instantly. $100 billion vaporized in hours.
Yeah.
And what triggered that catastrophic crash? I mean, did the Indiana plant burn down? Did Amazon cancel all their long-term agreements?
Nothing physical changed at all. The $100 billion wipeout was triggered by a single research note from a relatively small Korean brokerage firm, which merely predicted slight, routine delays in the development timeline for the next-generation HBM4 chips.
$100 billion over a single note predicting a slight delay in a future product. And then the very next day, the stock surged 27% on the NASDAQ.
It is your whiplash.
It really does. So what does this all mean? If you're an everyday investor or just someone trying to follow the trajectory of the tech industry, and you are watching a company's value drop 15% and then pop 27% in 48 hours without the underlying business actually changing a single physical thing about its operations, how do you navigate that chaos?
What's fascinating here is that the volatility wasn't just driven by human emotion or panic. It was mathematically amplified by the structure of the market itself. The reports detail how newly launched, highly concentrated leveraged ETFs in South Korea played a massive role.
Oh, right. Because these exchange-traded funds use borrowed money to amplify returns.
Exactly. So when that initial research note caused a small dip in the stock price, the leveraged ETFs experienced amplified losses.
And then came the margin calls.
Yep. To maintain their strict margin requirements, the algorithms running these funds were forced to automatically liquidate millions of shares. This forced selling drove the price down further, triggering more margin calls, creating a doom loop of mechanical selling that had absolutely nothing to do with SK Hynix's actual business fundamentals.
And when the panic subsided the next day, the same algorithms were forced to aggressively buy back in, fueling the 27% surge.
It's just machines trading with machines, completely detached from the silicon.
And then there is the access premium, which is even stranger. For years, if a U.S. investor wanted to buy shares of SK Hynix, they had to open a Korean brokerage account.
Which is a huge pain.
It involves navigating foreign tax regulations, currency exchange risks, and complex compliance hurdles. It's a massive headache. So when SK Hynix finally issued American depository receipts, the ADRs on the NASDAQ, U.S. investors flooded in for the convenience.
And the news reports note that at one point during the frenzy, U.S. investors were paying a 50% premium for the NASDAQ ADRs over what the exact same underlying shares cost in Seoul.
A 50% markup.
Is a deeply irrational market inefficiency. You are paying 1.5 times the price for the exact same legal claim on the exact same future corporate earnings, simply to avoid the administrative friction of opening a foreign brokerage account.
It's like paying a 50% markup on a brand new car just because the dealership is on your side of town instead of the next town over. The car goes exactly the same speed.
That's a great way to put it. It highlights a critical, fundamental lesson for anyone watching the artificial intelligence space right now. You have to aggressively separate the volatile algorithmic noise of ticker prices and ETF flows from the actual signal of the industry's physical fundamentals.
Yeah, the business of engineering and manufacturing microscopic 3D memory chips and the business of trading the stocks of the companies that make them are currently operating in two very different, often contradictory realities.
Let's bring it all together and distill this deep dive. The AI memory supercycle is undeniably real. It is driven by a massive, paradigm-shifting technological leap in how processing works.
And it is backed by hundreds of billions of dollars in real-world, non-cancelable orders from the most powerful companies on Earth. Without the physics of high-bandwidth memory, the AI revolution is just a parked Ferrari with no gas in the tank.
But the financial upside for investors hoping to ride this wave is heavily, heavily priced in by an efficient market that can read the same demand forecasts we just did. And the landscape ahead is fraught with hidden trapdoors.
Like the looming threat of Samsung finally conquering the physics of thermal compression bonding and flooding the market with supply. That's a very real when, not if scenario.
And the asymmetric air pocket risk. The possibility of hyperscaler capital expenditure drying up before the infrastructure generates a return that hangs like a dark cloud over the entire sector.
So whether you are prepping for a tech strategy meeting, reevaluating your personal investment portfolio, or just wildly curious about how artificial intelligence actually functions in the physical world, understanding these physical memory bottlenecks gives you a much clearer, more grounded picture of the future than just looking at the software models.
It anchors the boundless hype of the cloud to steel, silicon, and factory yields. The physical constraints of manufacturing, power generation, and supply chains will ultimately dictate the pace of software innovation, not the other way around.
Which brings us back to where we started. We think of AI as this weightless, infinite resource, but it's actually a physical engine running incredibly hot, entirely dependent on these delicate, microscopic, stacked chips. And we know this entire market currently relies on the world's biggest tech companies, spending billions and billions of dollars out of a deep-seated fear of falling behind their rivals. But I want to leave you with one final thought to ponder as you look at the headlines tomorrow. What happens to the world's most profitable, seemingly unstoppable memory chip companies the day just one major tech giant stands up, admits their AI isn't generating enough actual revenue to justify the cost, and suddenly cuts their infrastructure spending to zero? When the weightless cloud suddenly hits the hard ground, what breaks first?